We got to take a look at the S&P 500 because it's dropped just about 4% this month as investors worry about the Fed potentially delaying its first rate cut. Despite, though, those recent concerns, we've got our next guest who says a higher for longer scenario actually isn't necessarily bad news for stocks. Brian Belski joining us here at the desk, BMO Capital Markets Chief Investment Strategist. So, Brian, weigh in. Everyone's worried about it. You can see it clearly reflected in the market, but maybe it's not necessarily bad news.
It isn't, Shauna. Thank you so much for having us. Good morning, Yahoo. Just great to be here with the Smiths. We became a little bit more cautious on a near-term basis about 6 weeks ago, and several people questioned, you're not bullish anymore? No, we're bullish. And in fact, 12 years ago today, we launched U.S. strategy product at BMO, and we said, listen, stocks have entered a 25-year secular bull market, and that call remains the same. However, we do believe that momentum and the FOMO trade and got a little bit ahead of itself. I think the key thing that you said in your preamble was earnings remain the litmus test, the key. And from a fundamental perspective, earnings are stronger than everybody thought. I think I know most people thought we were heading into this March cut. I think the last time I was on your network, I talked about, I saw no analytical evidence that we're going to see some sort of a March cut, but yet so many people are so macro focused in that they're looking at Fed funds futures and giving Fed funds futures so much credit, whereas I think we're missing the kind of forest through the trees. Here's the forest through the trees. Since 2007, this has not been normal. This has not been normal since the great financial crisis. Pre that, very normal. And in fact, if you look at the correlation between interest rates and stock markets, it's basically meh. However, in a higher interest rate environment, certainly higher than 0 to 1% or 0 to 2%, stocks traditionally do very well. So I think we're recalibrating that. We still think from these levels, stocks are higher at year end. Now our official year end target is 5,100. Our bull case is 5,500. We published that in November. So we think that the market post earnings could get a little bit softer and give us an opportunity to be a little bit more aggressive in terms of buying stocks lower.
Does that mean new all-time highs then? Investors should expect, even if we don't see any rate cuts this year?
Yeah, so that's a great question. And so when we came out with our year ahead in November of last year, we said there's a very good chance the Fed's not going to cut at all because the employment situation fundamentals are so strong. And I think people didn't really notice that because, again, so many people are so focused on Fed funds futures. But what we think is going to end up happening is this return to normalization in terms of the average 10-year treasury over the last 75 years is 5%. So if we can hover between this 4 and 5% range and still have strong employment, but most importantly, have very strong earnings and oh, by the way, cash flow, I think the market can do very well as we continue to migrate and understand that North American stocks are the place to be.
Yeah, talk to us a little bit more about that normalization process in terms of where investors should be positioned, maybe companies or even sectors specifically that you expect to hold up a little bit better as we do see that normalization.
So we have the very good fortune at BMO to run 12 separately managed account portfolios for clients, real life clients in both Canada and the United States, and then 2 ETFs. So we look at stocks from a bottoms-up basis, and we think that most investors are massively underexposed small mid-cap. Doesn't mean that you're going to go and buy all small mid-cap. For instance, if you had $100, only 8 of that $100 is comprised of small mid-cap stocks on a publicly traded base in the United States. That's Apple and half of Microsoft. Think about that. So if you're a stock picker, right, you're salivating at that because then you can say, hey, I can have tracking error in my portfolio and add some really great small mid-cap franchises. That being said, to answer your question, from a large cap perspective, we like tech and financials. And it's not all the Magnificent Seven, because remember, the Magnificent Seven aren't all tech stocks. That's number one. Financials, we love the money center banks. The really small banks, so bifurcated, very big banks and very small banks, and asset managers and brokers. And then in mid-cap areas, we like communication services, consumer discretionary, as well as tech.
When you talk about this earnings season and what we're going to be listening for, what is the theme that needs to prevail this earnings season in order for some of your targets to be within sight?
Great question. Earnings consistency is the key. And I think from so far that we've seen, especially in the big financials, they've beaten numbers for all intents and purposes. And analysts have been very negative financials. And we think a big part of that has been over-reserved. And I think we're going to see more buybacks and more dividend growth. But at the end of this, it's not just all about AI, right? It's not just about those big cap tech stocks that have an AI attached to it. It's really more about productivity and continued gains going forward. And from an earnings perspective as well, free cash flow yields is very important.
Brian, when it comes to investor sentiment right now, because like you said, a lot of people like to still call you one of the biggest bulls on the street, but your price, your target for the S&P is still 5,100. Is that right?
Officially, yeah.
Any odds that you're going to increase it just given the run-up that we've seen? I know you're talking about the return to normalization and what that's going to look like here in the market, but any reason to be a bit more optimistic than maybe you were at the end of 2023?
I'd love to tell you my secret. I just love to, but I love my job more. So here's normalization, okay? Let's just, because this is my 35th year on Wall Street. I'm the Doogie Howser of Wall Street. You can look that up, millennials and Gen Zers, if you don't know what that is. So high single digit to low double digit performance in the stock market. Same thing for earnings. A trading range for treasuries, whether or not it's 3.5 to 4.5 or 3 or 4 to 5. Okay, in average multiples, you know that the average multiple pre Great Financial Crisis was actually 2 multiple points higher than since 2007. So again, I think we're heading into kind of a mid-90s environment before tech, and where we were really more stock pickers. And if you look back to the early 80s too, we were small, mid cap, and more stock picking too. So I think that's the environment we're heading into for the next 3 to 5 years.
Brian Belski, BMO Capital Markets Chief Investment Strategist. Brian, great to see you as always.
Thank you.